Everyone. Welcome to my presentation of why high. I tried to make this a couple different times, but I want to talk about what makes Hurley Investments a different advisor. I hope this makes you think because I'm going to go over a couple things that I think are very important for you. One, I'm going to go over the dislike of funds, how funds just don't help you in any way, shape, or form when you're trying to save money for retirement or you have an advisor that puts you in funds to help you make it to retirement. I'm going to talk about the 60-40 portfolio construction. That's a catastrophe. I'm going to show you some charts where the stocks haven't performed like they're supposed to, where bonds haven't performed like they were supposed to. And I'm going to make you think about what you are doing by way of choosing or what you're expecting your advisor to do for you for the percentage of management fee that you're paying him or her, I guess I should say. When people ask me, well, Kevin, what makes Hurley Investments a different advisor? I always ask that, or I answer that question by asking a question. It all starts with what the majority of people are invested in. When I ask people what they're invested in, I get every answer under the sun, from 401k to mutual funds. Someone recently pointed out, well, I got a ton of stocks now. My statement lists a ton of stocks, which is interesting because a way that advisors like myself are hiding what they're doing is they're really putting you into a mutual fund, but they're just listing all the stocks in that mutual fund. A key way to know if you're in a fund of some kind, when you have 8.437% of stocks. When you get those decimal points, you're in a fund. Or they tell me they're in some type of growth portfolio, that 60-40 growth portfolio. So it's going to protect them. I always call that the 60-40 portfolio catastrophe. But there are a couple points I like to point out, and people have wanted me to prove my points to you. So this is what I'm doing today in this presentation. Diversification was never protection in stock market crashes. Everything seems to go down. Now, I will admit, yes, there's small key areas, gold, silver, palladium, at times it's been crypto. Yes, there are small finite areas, but for the majority, when a market crashes, which happens on average every 4.4 years, everything goes down. I used to tease people, you're in a fund, you can never beat the S&P 500. How dare you let your money manager put you into a fund? And they said, well, you got to prove that to me. So I went to Spivia USA Scorecard of 2023. It's the most non-biased research company I could find. There's a 146-page research paper. 100 pages were just data. 46 pages was their data or their conclusions. If you willing to purchase their Spivia USA Scorecard, page 11, look at the 20-year table, or the 30-year table gets even worse, but over 20 years, 96% of active large cap funds did not beat the S&P 500. 97 of active funds did not beat the S&P 500. The scary part is 98 of funds in the general investment grade category, which is what 99% of you are in, did not beat the S&P 500. I'm being honest with you here. 80% of high yield funds underperformed. They did not beat the S&P 500, but that's a high yield risky bond fund that had a better chance than large caps, active funds, and all those wonderful general investment grade funds that 99% of your money is placed in. Now, there are different time frames. Here's the general thought process. The longer the time frame, the more funds underperform. I'm going to really focus on the 2000 to 2025 time frame because that's my time frame when the majority of my money has been invested. But understand, because of averages and that joke and scenario that we make you believe averages are more important than real returns. Because of averages, a fund could have a 40% return one year and then outperform the next 7. But if you annualize the return, it might fall in line with the S&P 500 for a period of time. What I'm trying to tell you is that over short periods of time, very finite short periods of time, when a fund excels out of luck, for a single year, for maybe 2 or 3 years, they might beat the S&P 500. But if you're looking at a historical pattern over decades, the 35 years you might be invested, you're going to find out you're not going to like the returns. Why do I not like the 60-40? I'm using a chart, I'm extending it out to 2024 and 2025, so I could make some changes here, but in general, since 1927, this one goes from 27 to 2023, or 98 years of returns. If you want to go ahead and tack on 24 and 25, which were up both those years, you had 26 down years and 72 up years. Adding 24, 25, we had 74 up years. 10 of those years, the S&P was down more than 10%. So a tenth of the time, the market was really bad. I want to go to the last 25 years, which would count 2001 till today. You had 5 down years, which means if you put 40% of your portfolio in fixed income, you missed 80% of the S&P gains on 40% of your portfolio. Again, I use 2000, so if I want to count that one and 2005, it's actually 26 years. You had 6 down years, which means you missed out on 77% of the S&P 500 gains. Now, yes, you had a 3-year period of time when that 60-40 would have beat the S&P 500. We probably made up for it on the next year. Almost had a 30% gain. Would you have been very appreciative to be in a 60-40 in 2008? Yes. But look at the gains you're giving up down the road. Huge gains. In any one of those years, it might be 10 years worth of your 40% return on those bond funds. I want to talk a little bit about fees, or what you're paying for. Figure out what you're paying your advisor for. If it's a down year, what's your typical response? Is he saying, oh, I'm protecting you, I'm moving or shifting money into more bonds, I'm putting in more into more fixed income? Or as you've been told, just to sit and wait it out? Just hold on, it's going to come back, don't worry. It always comes back. Do you realize that since 2020, we've had a lost decade or more, 12 and a half years? Where 12 and a half years you paid your advisor somewhere, I'm starting up here at 2000, 12 and a half years, maybe 1%, maybe 2%, maybe 3% you're giving your advising firm to tell you, just hold on, it's going to come back. A third of your investing time period, assuming you're investing from like 25 to 65, from 30 to 65, 35 years, maybe 40 years, 12 and a half years you had zero return. What does your advisor do for you when the market does these things? Just hold on, wait, it's going to come back? Well, I'm sure you were told up here, oh, I've got this great fund to put you in. Well, how great is it when 96, 97, 90% don't beat the S&P 500? Do they turn you into another fund that's going to do better? You know, it's commissionable. You know, they get a bonus, a spiff. We don't take commissions, but we get bonuses if we put $10 million into that fund in the month. What are they really doing for you? I'm not saying there's not a place for bond funds, but a 60-40 split, or catastrophe is one of the reasons why you won't have enough to retire on. It'll be one of the reasons why they're Walmart greeters. People are going to have to be going back to work because not that they didn't save enough, but their investments didn't perform enough. Bonds had somewhere between a 6 to 9 year, at least a 6 to 7 year period where you had zero interest rates. The Fed lowered their rates down. Did that mean they put you into something that had a zero rate? No. But if they're charging you 1% management fee, bond funds are commissionable 5 to 7%, you had no way in those treasuries to beat the management fees and commissions that you were charged. Now, I'm not a bond expert, but here's what I do know. Historical data for treasuries from 2000 till today, the average rate of return varies depending on market conditions, length of time on the bond, and the specific time frame analyzed. Returns for bonds are influenced by both interest rate payments and price fluctuations in the secondary market. I'm just going from 2000. Here's what I'm going to tell you. The start of 2000, rates were high because they were fighting inflation in the 1990s. Come into 2008, rates tanked. But before that, 3-year treasuries were coming off an all-time low and weren't paying very much. The 10-year treasury low, September of this year, hit a low of 1.7%. Why do I not like treasuries? Because they're commissionable. It may be a spiff. The advisor might not get the commission, but the firm does. On $100,000 in treasuries, $94,600 gets put into treasuries, or it could be as low as $93,800. Well, I gave them $100,000. Right, the commissions come out before they're put in. If you put $100,000 in, you'll notice the depositable amount of treasuries is somewhere between $94,600 and $93,800. The rest comes out as a fee or a commission. So Kevin, what do you guys do different? Well, Hurley Investments has different investment philosophies, or here's the reasons why we do things different. We believe Warren Buffett was the best investor, and the strategy of purchasing undervalued stocks is one of the most important things you can do to beat the S&P 500. I'm going to show you why here in just a minute. We protect stocks using a form of insurance through the long put option or derivative. We believe, especially since 2008, you guys need to be talking to us more often. We do a Monday night weekly webinar where you get to see exactly what happened the week before, what we see happening the following week, what we're looking at, how we're protecting your investments on a daily basis, not a couple year basis. Monthly email updates. We actually pick up the phone and talk to you. On big down days in the markets, we're calling out to our clientele, letting them know what we've done to protect their hard-earned money. We follow momentum stocks. One of the most important things I can tell you guys, we knew about the Magnificent Seven, the Magnificent 11, the BRICS. We've known for the last 3.5 to 4 years that 10 or so stocks gave the S&P 500 80% plus of their gains. Why didn't your advisor put you into those 10 stocks? If they're giving the S&P 500 80% of their gains, why wouldn't you be put into those that are making money? I'll tell you why. They don't do their own work. They throw the spaghetti on the wall. Let's get you into a mutual fund for a spiff so I can make more money. That's not working for you. We choose what to invest in. We understand why. We don't listen to Manager Monday Morning tell us what to invest in this week for a bonus. One of the most important things is every client's a friend. Every account matters to us because we have our money in the same thing that you're in as well. We make more money when you do. Here's my data. I've got who this came from down below. Less than 4% of all stocks have been responsible for the market's net gains going back nearly 100 years. Is it important to do some research and find those stocks? You better believe it. Even more eye-opening, just 1/3 of 1% of stocks created half of all the market's lifetime gains. I'm talking about names like Apple, Microsoft, and Nvidia. Apple alone has delivered nearly 4.7 trillion in shareholder wealth. That's almost 6% of all the wealth generated by the entire US stock market since 1926. The top 5 stocks have been 21% over the lifetime of the market wealth. Here's why it's so important to find those undervalued stocks. A Warren Buffett style of investing. The rest of the market, which turns out to be about 40%, most stocks either underperform, safe government bonds, or lost value altogether. I need you to understand, stock market returns are not distributed evenly, they're lopsided. A small number of big winners end up covering up for thousands of smaller failing companies. It's important that your advisors are crunching the numbers and actually doing something to find those stocks to put you into them. They'll tell you it's too much risk. In fact, I'm going to show you why it's not, but I've highlighted some more stuff in here. There's the sources all this information came from. But this is why protection on your positions is so important. Undervalued stocks have no time frame. Mutual funds have no time frame. Something that we like to do different is we want to have the right to sell a stock at a certain price for a certain period of time. I'm going to go through my example why. If you buy 1,000 shares of a stock for $100, you've just invested $100,000 in the stock market. If I was to ask you how much risk you have, you should tell me, well, every penny I have invested in the stock market is at risk. Your standard money manager tells you, hold on. Hold on, it's going to come back, even though there's a likely chance that it's going to lose half of its value. How often does that happen? Well, in the last year, Micron's lost half its value, Nvidia's lost half its value, Apple and Google have lost over 40%, Palantir lost half its value. There are a lot of stocks that lose half their value all the time. Is that scary? Is that worrisome? Better be, because if it loses half its value, you need 100% return just to get back up to break even. This is why you can't lose. It takes too much to get back up to a break even. Hurley Investments from the very start does things a little bit different. If we're investing $100,000, we want to lower your risk. The same 1,000 shares at a $100 strike price will have that same risk of $100,000. So to lower our risk, we're probably going to, at the very start, need another $4,000 to buy the right to sell your stock at that $100 price a share for a certain period of time. We start the position by spending a little more money to lower your overall risk in the trade. If we have the right to sell those shares that we bought at $100 for $100, our only risk is that money, that premium we spent to protect those stocks. Plain and simple, instead of having 100% risk, you have like a 96.1% protection. Your risk is 3.9% of your total invested capital. We spent 104, but we're protecting 100,000. It's pretty neat because at High or Hurley Investments, we've taught our clients to cheer just as loudly for falling stocks as those that shoot up to the moon. If our stocks that we invest you in drop to $50, we will still have the right to sell them at 100. Your overall risk is only that premium we spent to protect them. Why is this so important? If a stock's trading at 100, or excuse me, if a stock has fallen to 100, that we, I'm not saying this right. Why is that important? If the stock we bought at 100 falls to 50, we still have the right to sell at 100. Technically, we could sell at 100 and buy back in at $50 a share. We could double your share count from 1,000 to 2,000. Now, we can't just pretend we didn't spend 4,000. You have to divide that. So in all honesty, your cost basis is now $52. And we doubled your share count of stocks. If that stock trades above $52, you're slightly profitable, while everyone else has to wait till the stock gets back up to 100 just to break even. If our stock that we traded loses 50%, gets back up to $100 a share, we've doubled your share count. You now have 2,000 shares. Guess what? That 2,000 shares times $100 is now worth $200,000. When everyone else breaks even, we still spent that 4,000. When everyone else breaks even, you're up 96%. Now we will spend some more money. We will buy some more protection. You'll probably have a 90% return. But we're actively managing positions. We're putting protection on when stocks are most likely going to fall 15 to 25% or more. Those are called earnings events. We actually want stocks to lose 50% because we can double up on your share count. And when it comes back up to 100 in a year or two, instead of breaking even and getting churned out of a fund, you're going to have possibly a 90% return. I don't know about you, but this is the opportunity to have a really bad market with a fundamentally sound stock lose half its value to then come back so we can make a killing. I don't know if anyone's scared for our next market crash because we've gone up so much because of Donald Trump's policies. It's supposed to be one of the worst market crashes in history. Morgan Stanley calls it for somewhere from a 42 to 52% drop in our stock market. Some no-namer, I'm pretty sure, called for a 60% drop in our stock market. I'm letting you know we have the answer and we can make money, if not even break even or become slightly profitable in this kind of market catastrophe. If you have questions on how we do this, give us a call at 888-287-1030. Go find Kevin Hurley in the extension tree there. Really simple, really easy. I still have the time to sit down and explain this to you. What we're doing makes a difference in people's portfolios. What we're doing solves the crashes if we don't guess the stocks right. What we're doing gives you a much better chance than a 96%, a 97%, a 98% chance of not being the S&P 500. We've solved that issue on making that happen. Please give us a call. We look forward to hearing from you very soon. I hope this makes you think. I hope this makes you think about what can you do differently to get those returns that you deserve in the stock market. Give us a call and we'll go over this with you. I appreciate your time being here today. I do hope this was helpful. Until our next presentation, pick up that phone and give us a call. Thank you very much, everyone.